Insight into auditing.
Business entity concept. The business entity concept is a foundational accounting principle that regards a business as a distinct economic entity, separate from its owners. This principle forms the basis of accounting, assuming that business transactions should be kept separate from those of the owners. Moreover, it increases the owner's accountability when utilizing the entity's resources for personal use. In essence, the business entity concept recognizes and reinforces the distinct legal and financial identity of an entity. Business and owners are distinct entities, necessitating the segregation of financial transactions. This fundamental principle underscores the importance of maintaining a clear separation between the business and the owner's private matters. It differentiates between financial transactions of the business and those of the owners. The revenue and expenses incurred by the owner must not be mixed with the entity's business expenses. This concept emphasizes the accountability of the owner, particularly when utilizing business capital for personal affairs. Let's take an example in this context. A business entity incurred expenses of currency 10,000 for one of the owner's personal purposes. In this case, the business was involved in a financial transaction of currency 10,000. However, these expenses are not business expenses because they were incurred for the owner's personal affairs. They should be recorded as capital drawings by the owner. There are two aspects of the business entity concept. First one is legal identity, in which a business entity is considered a separate legal entity and business assets are separate from owners' personal assets. Second one is financial recording, in which business transactions are recorded independently of personal transactions. Owners' transactions shall not be considered as business transactions. Impact on financial reporting. The first one is to retain financial integrity. It helps protect the business assets from personal use and ensures that only business expenses are recorded in the books of the entity. The second one is reliable financial reporting, in which it ensures that the financial performance and financial position of the entity reflect only the business activity. And investors can have confidence in the financial reporting. The last one is to increase owners' accountability, emphasizing investor accountability for expenses incurred for personal purposes. In a nutshell, we can say that the business entity concept acknowledges the separate legal and financial identity of an entity. It enhances the owner's accountability for the utilization of business resources. It enhances the reliability of financial reporting.
Thank you for watching. For more videos, hit subscribe button below.